Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, June 17th, 2016. This video will be a combination of a market update as well as an educational video on using divergences. For those of you who followed the site for a while, you know I put a lot of weighting into divergences to help identify trend changes. And the other part of the video really is using those divergences as well as trading using multiple time frames. I mean, there's so many important things in trading, but one of those, really right there in the top five, if you would, is to always keep an eye on all the time frames. Early on as a trader, I still at times I like to actively trade, including day trades where I'm in and out the same day. And there are times, especially when the market volatility is real high, that I tend to get lost. It's easy to get lost in the intraday charts. In other words, we're looking here at an hourly chart, but maybe you're trading a 5 or a 15-minute time frame. By getting lost in that, I mean focusing only on that time frame and not keeping an eye on the other time frames. Because the most important takeaway from this video is when you see various chart patterns on various time frames, various technical developments, it's imperative to give larger weighting to the longer term time frames. So in other words, if you're looking at a breakdown of a bearish rising wedge pattern on a 60-minute time frame, let's say, that just broke down, confirmed, looks beautiful, then you see right around the same time a bullish chart development on a 5-minute time frame, you better step aside, pass on that 5-minute bullish development, breakout, whatever it is, because it's more likely to fail as the charts on the larger time frames play out. They're more significant. I'll give you some examples here, but let's dive into the charts and take a look at what happened yesterday. Yesterday, the markets fell to support. I don't have that shown on this particular chart. I showed the support levels that were hit on both the SPY and the QQQ yesterday. So the bounce was not any bit of a surprise. In fact, I expected a bounce in the morning, and we got one a little bit healthier than I thought it would be. But with that being said, let's look at some other things that helped confirm there might be a bounce. And this is hindsight analysis. I didn't point this out yesterday because I don't think too much of it. It's what I make up a lot of my own terms. I call this micro divergence. And what I'm referring to here, let's see. Okay, the micro divergence I'm referring to, micro just meaning small divergence relative to the time frame we're looking at. So I'm on a 60-minute chart, as I said, and these are the divergences that were put in place at the lows yesterday. And once again, another thing to add on is when I use divergences, I use those in combination with other factors. I don't ever trade on divergences alone. And just the same way that being oversold isn't a reason to go long, overbought isn't a reason to short, because oversold can become more oversold, overbought can become more oversold. Divergences can continue to build, they can be burned through. So I use divergences in conjunction with other things. In other words, yesterday, the tag of support with these what I call micro divergences. Micro because they're very small in scope. We're looking at a 60-minute chart. This goes back a few months, and you can see the size of these previous divergences that I've marked on the chart. So these were very small, and the takeaway is the expected move. And I don't think and I can tell you there's not any set formula as far as measuring that move, but the expected move when you have a divergent low or divergent high is typically commensurate with the scope of the divergence. So in other words, when you have a very small divergence, and I'm talking one that's just formed over a couple days or even sometimes hours, you can expect a move that will, a reversal that may only last a couple hours or a couple days. When you have these larger divergences out here, on the longer term time frame, I missed one draw right here. We have a trend line there. So you have the larger divergences that lasted a few weeks that led to this big move down. Here you had a case of consecutive divergences. You can see the first trend line here. I have a trend line drawn down. So we had a divergent low there, divergent low, all confirmed with the, we're looking at a MACD RSI and my 1333 trend indicator that I use on the 60-minute charts. And you can see there was a smaller divergent, led to a smaller pop, relatively smaller pop, relative to the size of that divergence. Then we set up what I call double positive divergence. These are back-to-back bullish divergences. We had a divergent low, prices had a pop. That first divergent, that small divergence that was put in right here where the vertical line is, that played out for a pop relative to the to the divergence. Then we put in another low. What that did is it expanded the divergence here. So we put in an even larger, more powerful divergent low. In other words, prices from this point here to this point here made a lower low, with all of the indicators that I'm using below making higher lows, i.e. bullish divergence. That was the scope of this divergence was much larger than this, so you had a much larger move to the upside. Now we'll go back here. You can see a divergent high really from this point, at least on the MACD up top. So a relatively small, medium size, would call it on the 60-minute time frame. There was a smaller divergence on the RSI. We didn't even have divergence there on the, well, actually we did. That was a slight divergence. I didn't draw it. Even if you have an equal high against prices making a higher high, equal high on one of the indicators, that's still divergence. So that played out for an initial move there, and then ultimately all that. Here was a smaller divergence. This is a good example here. You can see the divergence is in place and a relatively small move down. Now, this is a 60-minute chart. I would go back farther if I could. One of the limitations, and I don't know when they're going to catch up with the times, on TC2000, I love the charting platform. It's very easy to draw. The tools are easy to work with, the screen draw tools. It has some advantages, but one of the disadvantages is I think you have something like a 200 bar history on any time frame. So on a 60-minute chart, I can only go back a few months. So you have to then jump to a 2-hour chart, which I've done here. Throws these off a little bit because now each candlestick is a 2-hour period instead of 60-minute. But just to I wanted to just go back a little farther and show you, because just off to the left of that 60-minute chart, which we could only go back to about this point here, we had a much larger, very powerful, strong divergent low, you can see. And again, this is a 2-hour time frame. So this is showing you the larger divergences and just how well they played out. And we had this divergent low here and a very big move up. Then you can see a long standing, it wasn't very steep. That's the other thing to look at, is the slope of the divergence. In this case, it could have been stronger. If we had a much lower low here, we had some pretty steep divergence on the RSI and the MACD, but about equal lows on price, yet it still led to a big pop-up. This was a pretty long-standing divergence, although the slope wasn't very strong, but it did last for, let's see, I can measure it out with the screen draw tool here, that was 1.5 months. And there's your correction. Divergent high right there at this point, and then right after that we had a correction, and that put in a divergent low. So again, we're looking at a 2-hour chart, but these are some of my favorite time frames, especially when swing trading. I really like to look at the 60-minute charts. Again, I'll as I put up yesterday, a couple 15-minute charts. You know, when you get down to the shorter term time frames, that helps you hone your entries. Now let's wrap this thing up by looking at the bigger picture. And this is most important in my opinion, again, is keeping an eye on all the different time frames. This is the chart I've been putting up a lot lately. This is the SPY. This is a daily chart. This goes back 2 years. And, you know, I don't have all the divergences drawn out here. I'll show you another board in a second with all the divergences. But the bigger picture right now, what's going on, is we had this downtrend line off the May highs last year, May of 2015. So we're now over a year into, call it what you want, but the market's still below its highs that it put in over a year ago. And then I pointed out we had this recent divergent high and failed breakout. Divergent high because this high here was higher than this high, and you can see the negative divergence there. And again, now we're talking a daily time frame. We had a bull trap or a failed breakout, breakout above the downtrend line off the 2015 highs. We had some horizontal resistance there as well, this previous reaction high as well as that previous reaction high. Both of those were significant technical levels, both taken out. And in typical fashion, you know, my expectation even at the time before it happened was that that breakout was likely to fail. It was on low volume, other things, and it did fail. And the impulsive nature following that, the failure, meaning when prices move back below those two reaction highs as well as that downtrend line, you can see the impulsive selling. So far, so good. Now, yesterday's action, again, all it was, in my opinion, the markets are near-term oversold because we had, you can see, 1, 2, 3, 4, 5 red candlesticks, a nearly straight down move. We hit support on this 15, or I believe it was a 60-minute chart that I showed in the morning yesterday. And then I followed up with this chart. This was that ascending broadening wedge pattern, these two lines here. Call it that if you don't want to call it that. We had multiple tags. We had enough reactions on both sides. Odd to see prices within an ABW, ascending broadening wedge pattern. A little bit odd to see them this far out into the pattern, still within the pattern. In other words, I expected a breakout here, and this was, I'll tell you, just as I pointed out a bull trap or a false breakout, this was a false breakdown. See that one candlestick? This one managed to close. That green candlestick closed right on the line. Here, this little doji type candlestick broke down, and then prices snapped back up, and so you had the impulsive reversal. So this market has been full of trickery. Bulls and bears alike keep getting roasted, and I have to suspect that these are the powers to be, the big boys on Wall Street with the money to see the orders, the stop loss orders that all the retail traders and maybe even smaller institutional traders are trading. This was a very clear defined trend line. Call it an ascending broadening wedge pattern or not. It's hard to argue the validity of this trend line. We have multiple reactions, each of these candlestick bodies touching that trend line. That was a fake out. They ramped it up, broke out, and fell back down. So again, it's rough if you're a bull, rough if you're a bear, depending on how you're trading these. I was fortunate on the right side of this one, this last move. And now the point being that yesterday, when we hit that support on the 60-minute chart, we also hit the bottom of this ascending broadening wedge pattern, which I do think goes this trend line. This is all I'm really focused on now. This trend line means nothing at this point. That pattern, even if you extend this trend line, it would be too large to have any validity. So I just dismiss that pattern, at least this uppermost trend line at this point. This is what I'm watching. This is support right here. So essentially a break of below yesterday's lows should do the trick. And again, now we're on the daily time frame. To kind of wrap this whole thing up, this is what drives my short-term thinking and why I may choose, like yesterday, instead of covering all my shorts and going long, even though we were at support, even though I did think a reaction was very likely and we did get that bounce, this is what's driving me right now. So let's take a look at one other board. Let's see where I marked it up. One of these boards. Here we go. Okay, so we're looking at the same chart, daily chart going back 2 years of the SPY, in which case I've marked all the divergences. And if I missed any, pointed out in the trading room or under the post for this video. But let's just go back and look in time. So we had, at this point, I have two different trend lines drawing. This was the first divergent high. And again, these are daily divergences. This is where I put a lot more weighting, because with the daily divergent low or high, that leads to trend reversals, or often leads to trend reversals that last for weeks, if not months. These are the swing traders charts right here, the daily charts. The 60-minute charts can be used to hone down entries. Anything really under a 60-minute chart, if you're part-time, if you're swing trading or even trend trading, you work a full-time job, you want to position short or long for a move, these are divergences you want to put the most weighting into. And then once you get into your position, unless something changes in the chart, you may want to hold on to it. Like I mentioned yesterday to somebody, I'm in swing trade mode right now. There are many times where I might have gamed a bounce yesterday, at the very least hedged up at that support level. And I didn't do it because I had some other things going on. I didn't want to sit glued to the monitors all day. But so a swing trader, when you see these divergences, these are good for, you can see a big move. At that point, that divergent high right there was confirmed on both the RSI and the MACD down below. Price is making a higher high into that point, and we had a very healthy correction, as you can see there. And keep in mind, too, the market, this time period I'm looking at, the market has just ground around and really gone nowhere in the last 2 years. Although the ranges have been pretty big, but we're still at where we were, almost a year ago and even beyond that. So now what we had here is what I call, again, a double divergence or consecutive divergences. So after that divergent high, we did get the correction. What happened? Prices pushed back up again to make a second divergent high, and that point, that was your high right there in the S&P. We've never seen those highs again since. That was back on May, in May of 2015. And So what you have here is very powerful. Look at the scope of that divergence, because those are really, although two separate divergences, they're one and the same because they're continuous, back to back. And so that led to that huge meltdown back in August. So there was the divergence telling you warning of an impending trend change that played out. And again, I'm not trying to just make my case here. I didn't exclude any divergences that didn't play out. If you see any on the chart, let me know and I'll go and address that in the post on the site. Back here, we had a divergent low, the first divergent low in really that I can see on the daily time frame on this entire chart. We had a pretty steep divergence on the MACD. Prices made just a slightly lower low. You can see there on the SPY. Slightly lower low, slightly down sloping trend line, but really steep divergence on the MACD, very steep. So although in scope it wasn't very large, meaning the distance of the divergence, it was very steep and powerful, somewhat on the RSI, and that preceded this huge launch, this trend change there. Now, where are we at today? And this brings it all in. We had double divergence recently. You can just see a smaller trend line. It comes at this point with the peak, that lower peak on the RSI and the MACD, as well as prices peaking out. And as would be, it was a relatively small divergence, given it was about the same distance as this one, but not nearly as steep. And it did play out for a correction. But again, as I said, the scope or length or magnitude of these divergences is not always commensurate. In other words, you can't extrapolate the distance of the move, saying, well, we had a 1 month divergence here, so that will lead to a 1 month or X% rally. That's not always the case. But again, generally speaking, the steeper the divergence, excuse me, lost my voice there. The steeper the divergence or the longer standing the divergence, the more powerful, either in this case in time, not so much, or I'm sorry, in magnitude, the drop in the S&P, not so much in time, but it can play out either way. And in this case, we had a very sharp rally up. And now, like I said, most importantly, we had, following that divergence and that correction, we put in another higher high. And this, was clear for months now. This is what kept me on the failed breakout camp instead of buying into that breakout like so many. The fact not only that it was on low volume, but most importantly for me is the fact that it put in a second divergent high. And again, bigger picture, where we're at right now, we have a divergent high that's lasted now with the second divergence, trying to just measure it out here. We are at, from that point, that was about it says 2.7 months. So that's a pretty significant divergence. And in my opinion, that isn't it. I don't think that's all that's going to play out for that second divergent high. We had a reaction, as I mentioned yesterday, off the bottom of this trend line. Does it go a little higher? Possibly. Again, I gave you 15-minute charts, 60-minute charts yesterday. I gave you where my expected reversal zone is. But that is the reason. This is the reason. These daily negative divergences, which have led to all these huge major trends in the market, not just over the last 2 years. You can go back as long as you want. I've been doing this for many years. And so that kind of sums up my thinking. So when we get down to a 15-minute time frame or a 60-minute time frame or a 30-minute time frame, why I may choose to ignore a bullish development, or if I do see divergences like we did yesterday, these small micro divergences, why I think it might not play out for very much is because the larger trend, the more important, going out to that daily chart, we have that negative divergence that's relatively only just begun playing out, and so there's probably more to come. So either way, levels have been listed. Let me see if I can recap those for you that didn't see the static post. Okay, yeah, these are the charts I put up just after the close yesterday. This is, it was just before the close, about a half an hour. This level here, you can see the 38.2 Fibonacci retracement off this entire move down from the highs. That's about where we stalled out yesterday, and that came in right around with this 208, call it 2840 resistance. You can see a series of reactions right here, several candlesticks. We also have this gap back here that's still fairly fresh, and gaps will often act as resistance or support when tested from above or below. If we punch up through there, you also have this cluster. Let's try to range it here. You can see those pretty clearly, but we have this box of trading action there. So the top of that is horizontal resistance because it comes in on the top of all those candlesticks, as well as you can see the reactions right here, and then numerous reactions going back 1, 2, 3. So quite a bit of reactions there. This is a pretty significant level, and coincidentally or not, there's the 50% Fibonacci retracement, which is also a key fib level. So that's would be what I call the upper end of the expected bounce zone if we go a little higher today. And if we take it out, I mean, there's still room to go. You could retrace 61.8. Sometimes these retracements go even higher. But as of now, that's sort of where I'm looking to see a reversal. And if anything, if we go beyond there, I'll address that if and when those levels are taken out. So now let's just look at the Qs. And I gave you some similar levels there. Let me load another chart. Okay, this is the Qs and my reversal zone. Again, it's posted yesterday. This is my expected reversal zone right there. Anywhere from that 107.92 up to 108.37. Again, you have a similar, that sideways consolidation, very tight range, well defined. So the 50% or 32, the 38.2% fib comes in right in the middle of that level. There's a gap just overhead, and that gap, coincidentally or not, comes in right at the 50% Fibonacci retracement level. So, if we push a little higher, let's say I should include all the way up to the 50% fib, but I really do think that this range here will cap any advances. And again, we hit that yesterday at the close, so I made clear that, now we've already opened for trading. So you can see I started this video in pre-market. Now it's the market just opened. And again, I made that case yesterday. So we did stop cold right at that 38.2 fib, right in the middle of the reversal zone. And that's that. Let's see where we go from here. So right now, the most important thing, you can't say that the longer term or even intermediate term trend yet is bearish. You just can't say it. We haven't dropped enough. But the Qs, this is just one of many boards I have, one of many charts. The Qs have rolled off their similar downtrend line. They, like the S&P, they even had a weaker punch. I wouldn't even call that clearing out. We had a couple candlesticks above it. I'm referring to the downtrend line, the primary downtrend line on the Qs. So we've more than rolled off that. And like I said, I see considerable more downside in the coming days to weeks, despite any of these counter trend bounces. And again, if that changes, I'll change my thinking if and when the charts convince me. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed.